Everybody, and welcome to the third in our series of property and infrastructure webinars. As with all the IMAP webinar series, on Monday and Wednesday, we have dealt with individual investment approaches. Today, we are lucky enough to be joined by two representatives from advice organisations or advice-related organisations, and we're going to talk not only about investing in property infrastructure and more generally in private markets, but in particular, as we try to do in our Friday sessions, to talking about the role of this type of investment in portfolios and the portfolio construction implications of considering these asset classes. So before I introduce our two speakers today, let me just remind you that we're keen for your questions, and I'm sure, having seen the presentations, that there will be questions that come up for you. So use the Q&A button to send those through. So today's two presenters. First of all, we're going to have Matthew Swieconek from Findex join us. Matthew is the head of investment relations with Findex, and as head of investment relations, Matthew works in collaboration with the Findex investment team and was previously head of advice for Findex, and works with the Findex advisors to help construct and manage portfolios. And our second presenter, William Morgan, is the portfolio manager from Atrium Investment Management, an investment management business associated with the Fitzpatrick Advice Network. William's the portfolio manager for Atrium's private market assets, and you're going to see that come through in the presentation, and has previously worked closely with a number of asset managers across a wide range of asset classes, including liquid markets, private markets, real assets, and illiquid alternatives. And these issues of the incorporation of real assets and illiquid investments is one which is going to come up significantly through today. So, format of today's webinar is that Matthew and William are each going to take about 10 minutes to talk about their respective organisations' approaches to this asset class, property infrastructure and private markets, and the role in portfolios, and then we'll settle into a discussion period. So first of all, it's my pleasure to invite Matthew Swieconek from Findex to take us off with the Findex approach to allocating to property and infrastructure. Matt, over to you.
Thanks very much, Toby, and thank you for the opportunity to speak today on this topic, and thanks to all of our attendees. Welcome on this Friday. So, look, as Toby mentioned, my role is the head of investment relations at Findex. So I'm a liaison between our Findex investment team, research team, and our advisors within our wealth management division. So what I'd really like to do today is really just spend some time going through practically how we incorporate property, infrastructure, and I'll touch on some alternatives from an illiquid perspective within a managed account setup, and then some of the considerations that I guess we need to take into consideration when it comes to liquidity in terms of the types of assets that we have. I won't necessarily talk to the merits of specific assets, be that they are listed or otherwise within those particular categories. It's more so around the operational and practical considerations of these assets within the managed account setup. So just on to the next slide. So just a very brief overview of the way that Findex manages our portfolios. So we manage a series of multi-asset, multi-manager models within a managed discretionary account across a number of different risk profiles. So we manage anywhere between 49 to 55 model portfolios at any one given point in time within our MDA structure, and they really cover the spectrum of model types. So we have active series, we've got a passive series, a semi-active series, and SRI models. And all of those models include an allocation to both listed and unlisted property, as well as listed and unlisted infrastructure, as well as alternative assets, and I'll touch on those a little bit later. So all of our models are rebalanced on a quarterly basis. So we have a strategic asset allocation that we set for each one of our models on a 3 to 5 year time horizon, and we rebalance to a tactical asset allocation, which is our 3-month forward-looking view on markets. So, of course, given that we are rebalancing at such a regular cadence, the liquidity of our portfolios and the assets that we invest into really is key for us in terms of our considerations. But not only that, our client demographic being largely pre-retiree or retiree, that a lot of those clients are in drawdown phase, so we need to be really mindful of their ability to be able to access their funds if and when they need those. Next slide, please. So all of our asset allocation, all of our portfolio construction decisions begin with asset allocation. So down on the left-hand side there, we take guidance on our macro asset allocation piece from State Street Global Advisors, both on a strategic and a tactical perspective. So as I mentioned, every quarter we are potentially changing our exposure to each one of those sectors down the left-hand side, as well as the subsectors that sit within, depending upon market conditions. So we really are quite agile in terms of the way that we are shifting our portfolios across the various sectors and subsectors. So as a consequence, we need to be able to have that liquidity to be able to move. We also run a number of different styles within each of those sectors, depending upon, again, market circumstances. So depending upon a client's risk profile, we primarily service retail clients. We do have a small wholesale cohort, but we've decided as a business many years ago to treat, irrespective of client size, all of our clients as retail from an operational perspective. It just works better that way for us. So each of our clients who are mapped to a particular model will have an exposure to each of those sectors, subsectors, and styles within their model portfolios. And as mentioned, each one of those will have access to property and infrastructure, real assets, as well as alternative investments. Moving forward. Sorry, if we just go back one, I think we might have missed. No, okay, that's fine. We'll move along. So just zeroing in on the topic of today, really, which is around property and infrastructure, and just giving a bit of a sense as to how we incorporate unlisted property in particular and infrastructure into those managed account portfolios. We do include them within our models. We don't sit them adjacent to our models. So coming back to my point earlier on, liquidity and being able to be nimble with these assets is really a key consideration for us. So when we are engaging a manager to manage a portfolio on our behalf within our models, we set up a specific set of parameters or a framework that suits our portfolio. So we need to make sure that our property and our infrastructure and our alternative assets are operating at a portfolio level, not necessarily just on a standalone basis, because whenever we're constructing our portfolios, we're looking at it at a holistic level as opposed to individual sectors alone. So, for example, with our property and infrastructure, the parameters that we set from the outset of our relationship with our property manager, we set up an IM that's really quite flexible, but has a number of parameters in there to make sure it suits our needs. So, for example, we run a 50-50 listed, unlisted exposure within our property and infrastructure strategy, which includes some listed and unlisted infrastructure securities within that. In terms of the income generation, within our listed portfolio, we make sure that a minimum of 50% of the income or the EBIT that is generated from those assets is from recurring property rental or recurring sources that are contracted if they are in an infrastructure sense. And a minimum of 50% of our assets need to be located in Australia at any one point in time. We recognise that there are different levels of, I guess, property development from early stage and development through to the more established properties. So we also set an asset, a TAA within that property and infrastructure fund, which stipulates that we can hold 70% of our exposure to core assets, those that are typically single asset established assets with not a great deal of development requirement, 20% value add and 10% development, where our manager can get involved to add additional value to those properties. And obviously there's a greater risk and return relationship associated there. We take on both equity and debt within those properties, but we do have a bias generally towards equity. And within our listed component, we typically only hold somewhere between 12 and 20 listed assets at any one point in time. And obviously the benchmarks are noted there. So it's a pretty robust property and infrastructure strategy to make sure that we can cater for those liquidity requirements. But it does also include quite a substantial portion of unlisted. And I might just get you to go to the next slide there, which explains in a bit more detail the sectors that we do invest into. Thank you. So on the top left-hand side there, you'll see the sector breakdown at the moment across office, retail, industrial and infrastructure. So it is quite an even spread that we currently have. Obviously office at the moment, there's a lot of talk about the office sector. If you look down at the bottom left-hand side, you'll see that we are currently underweight, but the assets that we do hold are typically tier one assets with tier one law firms and tenancies that are long-term, or government tenancies that have long-term tenures as well. So we're making sure that we really do have strong contracted revenue streams in that particular sector. From an unlisted and a listed perspective at the moment, we are slightly underweight to target with our listed book. I've opted to take more of an unlisted exposure, but as you can see there, from a liquidity perspective, we're still holding upwards of 45% worth of our portfolio in this particular segment that remains liquid. And as I mentioned, that allows us just the ability to rebalance on a quarterly basis, as well as accommodate those withdrawals that clients have. And just touching on alternative strategies, I know that the title of the session today is property and infrastructure, but there's also an element of illiquidity, I guess, that a number of the alternative strategies do bring to bear. And in much the same way as we formulate our property and infrastructure mandates from the outset of an engagement with a manager, we do likewise with our alternative strategies. So we run two complementary alternative strategies within our managed accounts. One being a defensive alternatives, which obviously has a lower return hurdle and a lower budget of volatility, and a growth alternatives portfolio as well. And as you can see there, we from the outset of that relationship with our managers in this space, so with our defensive alternatives, we work with a company by the name of Wellington Asset Management out of Boston, and with our growth alternatives, we use Grosvenor Capital out of Chicago, and these are feeder funds, fund of funds. So each of those funds, as you'll note, they have a minimum of strategies that sit underneath them. The defensive alternatives has a minimum of 5, growth alternatives has a minimum of 8. In reality, they probably have 2 or 3 times that level of strategies that currently sit underneath those unit trusts at the moment. So we engage with the manager and provide them with our parameters around the returns that we're seeking, the volatility budgets, the liquidity that we require, and also our fee budgets that we have for these assets as well. And the managers will then go about constructing a portfolio of underlying alternative strategies to achieve those parameters. So if I might just ask to flick to the next slide, it's got a little bit more detail there around the types of strategies that we do employ within our defensive and our growth alternatives. I'm not going to go into a great deal of detail, obviously, around the different types of underlying strategies within each, but as you'll see there in the defensive versus the growth, there naturally is more of a defensive bias within our defensive alts relative to our growth, which is a little bit more equity and risk-based. But as you can see there, from a liquidity profile perspective in the bottom left and the bottom right, many of our positions still can be liquidated within a 30 to 60 to 90-day period. And again, that's done very much purposely to make sure that we can rebalance where we're required. A lot of the strategies that we do invest into are reasonably liquid in nature because they are long short, say equity or credit strategies. But we will start to introduce more private markets and more illiquid strategies as the scale of these funds do grow. And I guess we are in the fortunate position that we do have some substantial scale in these funds, which does allow us the opportunity to take a little bit more of a longer term horizon with maybe some venture capital or private equity investment if we see that there's an opportunity there in those sleeves. So next slide, please. So long story short, we've looked to build an all-weather. I know it's a bit of a cliche, but it's an all-weather property and infrastructure strategy. So that 50-50 listed, unlisted strategy really holds us in good stead. Clearly, we're trying to build a mandate or a strategy that is lowly correlated with our other assets within our MDA models, has good stability, really consistent levels of income, and the way that the portfolio is structured really does lend itself to that at this present. There is the flexibility to rotate between listed and unlisted and private debt, which we're starting to introduce more so into that portfolio, which is property-related debt as well. And we've got a good relationship with our manager. We deal primarily in this space with Alcyon, who's our primary manager in the domestic space. And they will work with us proactively if there is a position that they are looking to liquidate or invest into. We have advance warning in terms of those positions. And likewise, if we are looking at making a major change away from that particular sector during one of our rebalances, we'll always endeavour to give us as much advance notice as we possibly can, just to make sure we're not in a position where we're selling assets at short timeframes. So we typically allocate around 99% of our models across the board to property and infrastructure and approximately 14% to those two alternative strategies. And again, just coming back to, I think I've mentioned it about 15 times already, but that whole aspect of liquidity, given that we are dealing with a retail client base that does require that element of liquidity, we need to be mindful of that with all of our strategies. And clearly the types of assets that we've got in there do really need to fit the bill from a risk and return perspective for those clients. So that's very briefly the overview of how we practically manage property and infrastructure, and just touching on alternatives within our managed accounts. I'm sure there'll be some questions that come through, but thank you very much for your time. I'll now hand back to yourself, Toby.
Thanks very much, Matthew. And now it's my pleasure to hand over to William Morgan, who's a portfolio manager from Atrium. Atrium, probably less well known to many of you, but the investment management arm that's associated with the Fitzpatrick advisor network. So, William, over to you to talk about your approach to allocating to property and infrastructure.
Thank you very much, Toby. Yeah, I mean, as Toby mentioned in the intro, Atrium is a subsidiary of the Fitzpatrick's Group, and I think it's worth explaining that at its core, Atrium is a multi-asset investment manager where we develop and run products that are investment solutions for both investors and clients, traditionally through the Fitzpatrick Group, but more and more broadly distributed across the private wealth market. Fundamentally, Atrium takes an unconstrained approach to portfolio construction, where we don't adhere to any strict SAA. We look more through the lens of a risk-targeted approach, and certainly when we're looking to allocate, we've got a very firm bias towards valuation. We want to buy things that are expressing good value. This really does flow down through all asset classes, all sector-based decisions, and even when it comes down to asset selection. As Toby mentioned, I'm the portfolio manager for private markets within that multi-asset construct, and so have a fairly direct gaze into the markets that I operate in, but the information that I get within my world flows up into the multi-asset, and certainly information from our global multi-asset investment capability comes down into my decision making. Historically, Atrium has had a domestic focus when it comes to private markets, but before we go there, thinking about property and infrastructure, which are the two main items of this series this week, infrastructure we have traditionally approached through listed markets, and I think really thinking about what's the driver of that, our return on equity requirements are quite high in private markets, which I'll explain a little bit later on. And I think traditionally infrastructure, with its long-term, contracted revenue streams, has been incredibly attractive to the institutional market in Australia, and that has driven down sort of expected returns in that space. And so it fits more within our listed market exposures, which doesn't fit into my world. However, property is an area that we've been very active in private markets. And again, we take a very unconstrained approach. So we invest both in equity and in debt, so across the capital stack. Private markets otherwise, we invest into things such as agriculture and corporate loans, whether it's private equity backed businesses or special situations. I might ask for the next slide. So to take a step back, how does Atrium use private markets? And there's two main pools of capital that we allocate into private markets with. One is in our Evolution series, which are our flagship multi-asset funds. These are retail products, multi-asset, that are offered with weekly liquidity. However, Atrium has engaged in private markets through these portfolios for over a decade. Because of their liquidity wrapper, it's very necessary for us to constrain our allocation to private markets versus potentially other types of multi-asset funds that you find in the Australian markets. What does this mean? We tend to run about 12% of our overall assets in private markets. Currently, we're a little bit underweight due to the opportunity set that we're seeing right now. It's worth noting, though, that the private market sits within our broader diversification or diversifier buckets, which is predominantly otherwise populated through liquid alternative strategies, which we've listed in the pie chart on this slide. So what does that mean, though, by constraining our allocation? It really means that we have a much higher return expectation on our private market investment. That's probably a fundamental driver to where we've decided to allocate to infrastructure, say, via the listed space, and it certainly informs our asset selection, where we're trying to find assets that are going to deliver a higher return on equity, and that takes us into more value add or core plus in real estate. It makes us seek returns across the capital stack by potentially engaging in mezzanine style transactions. But fundamentally, on a portfolio basis, we look for diversification. We think this is the fundamental thing in private markets investment, from a portfolio construct, which I'll describe a little bit later. And then the other major criteria is entry price valuation. That is something that drives every allocation. Are we getting this at the right value? And that sort of stems from the Atrium philosophy of not really adhering to or trying to have as few constraints as possible. And I think that's resulted in a very successful experience in private market investments. The next slide, just talking briefly about our capability in private markets. So our philosophy is to build a robust portfolio of private market assets, diversified by asset class, positioned in the capital stack, and across geographies, with an emphasis of delivering solid risk-adjusted returns over a prolonged period of time. We've got a very broad mandate, which at its core has flexibility. What this means is that we can move opportunistically across all of the sectors that we have access to find assets that are presenting the best value at a point in time, building them into a portfolio that's going to deliver a steady outcome to our investors. Traditionally, Atrium focused on real estate style investments, whether that's through equity or through debt. But over time, we have diversified out into other sectors, such as agriculture and such as into corporate debt. I skipped over previously. I mentioned earlier that we have two major pools, and it's worth at this point to describe that. So one pool is our private market allocation through the Evolution Fund. Atrium, though, has moved with the times and provided managed account solutions to investors. That probably accounts for roughly half of our capital, our assets under management. And the managed account structure doesn't allow for direct private market allocation, in at least the way that we structure it. And so what we've done is we've built what's called the Atrium Real Assets Fund. It's available through platform. However, it effectively is a lock-up structure where we ask clients specifically to allocate their capital for 5 years. And that allows us, that gives us the capital certainty to invest in assets that are going to take that time to realize. So that is a conscious decision to an advisor that is putting their customer, their client rather, into a managed account that Atrium provide, is to take a portion of that allocation and commit it to a long lock-up period. And really that fundamental request from us allows us to build the portfolios that we think private markets can deliver. So sorry about jumping backwards and forwards on the presentation. If you could go forward to the next one. Thank you. So I suppose just to recap on maybe some of the things I've touched on, our philosophy, valuation is key. We believe that long-term returns are closely related to the price that you buy these assets in. Now, that doesn't mean that you buy bad assets at cheap prices, but it does mean that the fundamental value of the asset needs to be at a premium to our entry price. And what this does is it really provides us with a lot of downside protection. These assets, they're not always the most straightforward things. A lot of the time they're operating businesses effectively, sometimes with a real asset that underpins it. And the original business case for investment thesis isn't always realized in a straight line. And if you have entered the asset at the right price, it just provides such protection as you work through the business case and gives you much more certainty on an exit basis. Fundamentally, that is ensuring there's sufficient margin for safety, really reflecting the inherent risk that exists within private market. We also always want to seek reward for illiquidity. We want to reward our investors for entrusting their capital into our portfolios and into our process. And that's something that we seek both in terms of the caliber of assets that we invest into, but also in terms of the prices that we're paying. But one step away is the portfolio itself, and again, just driving home the importance of true diversification. We want to find individually outstanding investments that are fundamentally unrelated to each other. You can never get completely unrelated to each other, but we're always looking to diversify by risk and by return driver. The next slide is probably just showing the track record of our real assets fund over its 9+ year track record. As you can see, the product of our process is a very consistent return over time. The 1 year number is interesting. It's certainly underperformed in the last year, and I think anybody that's got an allocation to property equity is going to be experiencing some headwinds from a valuation perspective. But the fact that we've diversified those exposures, both within commercial property to industrial, to retail, to office, has meant that we've got stability in our property equity portfolio. But then the debt component of our portfolio has also risen in some cases with base rates, but also provided a buffer in terms of regular distributions, which overall has meant that the experience for the portfolio has not been critically bad, but also meant that we can maintain our positions to benefit into the future. The next slide, I've just got a few charts. The major metrics are masked, but what I've tried to show here are the sectors that we've engaged with over the 9.5 year journey at Atrium, to show how we've diversified across regions and also diversified across asset classes. Embedded in these charts are 65 investments that we've made over 9.5 years. It includes 43 exits. And you can see that not everything has been in line. It's not a straight line. Private market investments is inherently risky, both from a duration perspective. Some assets take much longer to realise than others, but it's the diversification that allows for a much more consistent return profile. If you look at our asset classes, there's two particular sectors that are perhaps underperforming others. One's agriculture, the other one is private equity. And we believe that the investments we have in those two spaces are the prime candidates to drive returns on a forward-looking basis. They've been supported on a portfolio basis by our private debt portfolio and our real estate portfolio over time. But it's really, again, just to reiterate, the diversification that drives the consistent return. And that's when we talk to clients, why should you invest with us, into our portfolios? And that is that we provide that diversification, we provide that flexibility to be allocating actively through the cycle to the sectors that are most appropriate at that point in time. And we provide that hands-on management to ensure that assets over time are going to deliver to their underlying investment thesis. So, Toby, that's what I wanted to cover. Hopefully there's enough there to generate some questions.
Right. Yes, indeed there are, and there a couple of questions have come through. And so, what I wanted to do is talk about a number of things which came out of both of your presentations for me. And let's start off with the sort of fundamental one of the role that property infrastructure and sort of private market investments or alternatives, in your case, Matthew, the role that you see them playing in a diversified portfolio, in the overall portfolio. So William, perhaps let's start with Atrium's approach. You're on mute, I think, William. Yeah.
I did. Look, I mean, you know, at the high level portfolio, it's all about diversification. And albeit, you know, we can invest into real estate in a listed framework. We do invest into infrastructure in a listed framework, but we're not averse to investing into infrastructure in the private market context. We're seeing quite a lot of opportunities coming through, which are maybe they're outside of the traditional institutional style infrastructure assets, particularly in renewable energy, particularly in the transition of the energy network, where that is the space where traditional infrastructure lives. But opportunities are coming that are allowing us to hit our return on equity expectations. Fundamentally, we're using the illiquidity budget to access parts of the market that are not available through the rest of our multi-asset portfolio.
And Matthew, you talked about sort of typical exposures of 9% to real estate and 14% to alternatives.
Yep.
So what role do you see those playing in a balanced or growth portfolio?
I often refer to them as our cushion, or our circuit breaker, if you will. So the assets that we have there are designed to be really quite static in our model. So we're not we're not envisaging large swings or tactical adjustments away from them. The tactical adjustments that we typically make are in our bond and equity books. So they're there undoubtedly to provide us with those lower drawdown characteristics that the equity books and bonds over the last couple of years have undertaken. A little bit, you know, more stability in portfolios and uncorrelated returns. So that, as Will mentioned, they just give us access to those sorts of assets that we haven't necessarily been able to access in the past. But what they do is you know, provide us with a great deal of diversity when it comes to, you know, uncorrelated returns and much more smoother returns over a period of time. If you look at the drawdown characteristics, particularly of the unlisted assets and alternatives, I often say, you know, clients will forgive us for missing a few points on the upside, so long as we're not wearing the full downside risk when the market falls, and that's precisely what these assets are designed to do.
You both talked about investing up and down the capital stack within these asset classes, and I think it'd be interesting to spend a few minutes talking about how you distinguish between equity and debt and types of debt in property and infrastructure, and you know, how you make decisions as to whereabouts in the capital stack you're going to take your exposure, or the ratios of the different parts of the stack that you're going to include.
I might hand pass that one to you, Will. That one sounds right in your wheelhouse.
Yeah, I suppose, yeah, and maybe we do have our hands across the assets a little bit more, just a function of the way that we allocate to the portfolio. You know, if I think about now, you know, equity valuations have certainly retraced. I guess the question is, have they retraced sufficiently to reward you for going into the equity component of an asset versus debt? And where you're seeing returns on debt, given where, you know, risk-free rates have gone, and there's no doubt in some parts of the market, liquidity has become much less available for people seeking debt, which has blown spreads wider to some extent. Maybe blown is the wrong word, but certainly widened spreads. And so where we're seeing senior secured debt right now, compared to especially in office where the income return is somewhat challenged, impaired, some would say. The changing usage patterns. It's very, very different in industrial. There's a lot of support for industrial valuations, and there's an enormous amount of demand for those kind of assets. Retail is sort of sitting in between both. It's kind of had its disaster in the past with moving to e-commerce and to a lesser extent COVID. So it might have found more of a flaw, but every sector's got its own little, sort of idiosyncrasies. And then you're comparing kind of equity expected returns looking forward versus, what you can get for debt. And then within debt, senior, stretch or mezzanine. And, certainly when you're going up into the more subordinated parts, you're really fundamentally got to be very, very sure about, underlying security, because you're effectively credit enhancing the asset, and you've got far greater leverage exposure on the downside. So right now for us, we're very cautious. We're very protective of our capital right now, and I think being that way over the course of this year has rewarded us in terms of the caliber of assets we're seeing coming through our pipelines is probably better than we've seen for many years, and that is both quality of asset and that is entry price valuation. And but it's a really case by case criteria, and I think fundamentally we prefer to have security in a debt kind of structure. We like the consistency of the returns, and unless we're seeing the necessary reward on the equity side, that drives a lot of our sort of decision making. But that being said, we're very open to all types of transactions, and we assess every asset on its merits. But it does come down to sometimes, a judgment on relative valuation between assets, just because capital isn't always available, and you've got to make a choice.
That's an interesting point, and it's one I was going to come back to, which is this. Once capital's been committed in this into this part of the portfolio, because the underlying assets are relatively illiquid. As new opportunities come to you, or Matthew, as new opportunities come to the managers that you use, how much freedom do you have to invest in a relatively rapidly changing market? A lot of infrastructure opportunities are now starting to emerge. So to what extent do you find your portfolios are in the things that you already own, rather than having capital available to you to invest in new opportunities?
Yeah, well, for us, Toby, I think that's why we've opted to have that hybrid type of arrangement, which is that 50-50 at a target allocation level, exposure to both listed and unlisted markets, so that if an opportunity does arise, as we saw, we've got a slightly underweight position in REITs at present and listed infrastructure. It just gives us the optionality to move pretty quickly, and we can. So if we do see, for example, an unlisted infrastructure or property opportunity, it does give us that flexibility to move pretty quickly. And I guess that's why the IM was designed that way, to give us that flexibility, that we don't have to sell down potentially other unlisted assets on a secondary market when it's not necessarily the best time to do that.
Yeah. William, what about for you? You're actually making individual investment decisions.
Yeah, but to be clear, we've got we invest via syndicate mainly into direct assets. We have diversified funds. We invest with managers where we think that's the best way to approach certain sectors. But fundamentally, our portfolio has been matured over more or less a decade kind of period, and we have a fund that has a term structure or a liquidity profile. We've got a series of redemptions that occur over time, and we need to manage our portfolio to that, respecting the liquidity profile of it. And so we are certainly finding liquidity in assets where we think the investment has run its course, and we're looking to deploy capital right now into the best assets that we can find given the current circumstances. But once you're set, you're in the chute with these assets, and you've got to see them through more or less. And that's why we've structured our portfolios to allow the freedom to do that. And you're working with either the business owners or the asset managers or the fund managers to deliver to that that original investment thesis.
One of the differences between your two approaches spoke to the issue of liquidity. William, you said that you have for your real asset fund, you have a requirement that the client commits to a 5-year period. Matthew, you spoke quite a bit about the benefits of remaining liquid or
Yep.
enabling yourselves to meet clients' liquidity requirements. That did seem to me to be an interesting point of difference between you. I wonder. I mean, William, how easy do you find it to say to clients, this is a 5-year lockup, effectively?
You'll have to ask my partners, my colleagues in the client-facing role. But look, it was a conscious decision that we made when structuring a product, and that allows us probably a bit more granular control over the portfolio. Whereas I'm sure that Matthew would need to set very clear parameters with their underlying investment managers to ensure that in the aggregate, they can service the liquidity requirements at the platform level. We certainly do that, at different layers of the portfolio. But I think it's our approach to building the portfolio, our approach to investing. We fundamentally say to people, don't give us your money unless you're willing to put it away for a period of time. And by doing that, we will try and reward you with consistent returns that are fundamentally diversified from what you're going to get into listed markets.
Yeah,
our structures allow for personal situations where if we've got a small investor that has a change of circumstances and they desperately need the money for a good a valid reason. Of course, we can facilitate that. But it's just more if markets are down 30% and everyone's panicking. It's like, well, hang on, that's not what we said to you up front, and making sure that the experience that they have through the course of their investment is what we promise up front.
And Matthew, how do you how does Findex manage the sort of liquidity? The fact that these are fundamentally relatively illiquid assets.
Look, we're fortunate in that, I guess, from a structural sense within the strategy itself, there's satisfactory income production. There are inflows into the fund to be able to continue that level of liquidity that we do need. I guess as we'll mention, and given that there is that 50% exposure that we are holding to listed assets, is still is a very liquid vehicle. But I do foresee that there are opportunities that we'd probably miss out on that we could be taking up, but that the managed account structure at this point in time just may not be able to cater for that. So, there are opportunities that advisors can still use that sit outside of that framework, for example. And it's a matter of just positioning that with clients at the outset that, look, this is a longer term time frame. And these instruments have been around syndicates have been around for a long time, so they're nothing new. But it's just setting that expectation from the outset that it is a 5 or a 7 or an 8 year plus lockup that you need to take into consideration. You won't have your capital for that period of time. We can manage that to an extent within a managed account with the liquidity of A-REITs and cash. But at some point there might be some single assets that clients want to take up that we just can't put within that managed account structure.
But both of you have created vehicles to get access to this type of markets, and that gives rise to a couple of questions. One from the audience, which says to what extent how do you manage the conflicts that come from being both a portfolio manager and effectively an investment manager? So to what extent do you manage those conflicts? And there's a second question which I think is important to me, which is what sort of scale's necessary, do you think, to be in a position to create these vehicles? But let's talk to the conflicts one first, of incorporating products that you've got an involvement with into portfolios.
Yeah, I'll take that one. I'm more than happy to. I mean, everything has to be done in clients' best interests. Okay, so first and foremost, whenever we are seeking to bring a solution into our managed accounts, and as I mentioned, all of our clients primarily are retail clients. We've got $9.5 billion that sits on a managed discretionary account, and we do bring in some investment products that we act as the RE and have a unit trust around that we place into those structures. But that's only done when there's an opportunity that we can take advantage of, either offshore or in the institutional market that we can't get access to in the retail market to invest on platform. Because at the end of the day, we are investing on platforms. So, if we look at, for example, our alternatives set of strategies, these aren't strategies that you can easily avail yourself of in the retail market here, and they do serve a purpose. They perform very well, and they do perform for our client cohort that we have. So from our perspective, it always has to be in that client best interest, and we're very, very comfortable that we are fulfilling that obligation.
William, what's the Atrium approach to?
Look, our approach is, and just to be clear, we do invest into individual assets, and part of my job is to diligence those assets and really understand them and work with the asset manager to deliver the outcome. But Atrium fundamentally is an allocator. That hasn't always been the case through our 10-year period. We run assets ourselves, and we made a conscious decision from a governance, but also from a freedom perspective to change that approach and to move to strictly an allocator. And that means that we have very clear lines of demarcation. I'm acting in the best interest of my portfolio and therefore my investors. So there's no outside of the fee associated with the fund. There's no fee associated with the asset or the transaction. Everything is done at an arm's length. And we are fundamentally acting on behalf of our investors. That has always been the case, but it's true when you're mixing the allocator function and the asset manager function, it can get muddy. And we've resolved that by making it very clear that we are allocators, but we are using the question of scale. We are definitely using the power of our platform to find opportunities, like the best opportunities for our respective pools. So we've got the benefit of having a much broader capital base than potentially other funds that are doing maybe earlier stage, and that allows us to access a broader array of markets, and that builds that kind of diversification. But it also allows us to build very meaningful relationships with the asset managers, so that we're able to really work closely with them.
Matthew, you mentioned the relationship with Alcyon, I think it was. Again, same question to you. I mean, Findex is one of the larger advice organisations in Australia. I mean, to what extent, what level of scale do you think is necessary to achieve the sort of service offering that you've been able to bring together or pull together?
In terms of capital?
Yes, yes, yeah, and both capital and I guess the human resources that then flow from that. Yeah.
Yeah. Okay. Look, from a capital perspective, um, for that sort of, I guess, bespoke type solution, you'd probably be 50 million funds under administration, probably to get some scale there. From a human resource perspective, look, it doesn't take a lot as far as relationship maintenance is concerned. We have, for example, our relationships are all directly with the portfolio managers. They're within that arrangement, and so we're lucky because we do have a fair bit of scale there, and I've mentioned that a few times. But in terms of the personnel, our relationships are pretty well direct with the money managers, the portfolio managers themselves.
Yeah. Okay. Look, in the last couple of minutes, one of the questions which has come up is the level of understanding of clients and I suppose also of advisors of what type of investments are included in this part of the portfolio. To what extent do you think to what level of understanding do clients need to have? What level of understanding do they have about these types of assets?
I mean, look, at the end of the day, we're talking by and large about real assets. Like, these are things you can drive to, you can kick, you can see. You go, you go to a shopping centre, you drive over a bridge, you pay a toll. They're tangible things, so people kind of get them fundamentally. The underpinning drivers of returns, valuation, the way that the balance sheets are structured, and the way the risks that are inherent in any particular investments. Obviously, that's much more nuanced, and it'll come down to the amount of engagement that an advisor or a client wants to have with me. But we try and take them on the journey with us. There's regular communications. There's always opportunities such as this where you can kind of explain, but I don't know how well I've done today, but where you can explain what it is you're trying to do. But I do think that's why we try and promote the portfolio style approach. So there's a lot of advisors that have an opportunity to invest their clients' money into single asset syndicates and single asset opportunities, and and that's appropriate for people who can handle the volatility of the journey. But what we say is, come into this portfolio, we'll give you a very, we will aim to give you a smooth return journey that's built upon the fundamentals of diversification. And that's true across any investment, whether it's listed or illiquid. And I think it's especially true in private markets.
And just to add on to that, Toby, it'd be rare for clients coming in to see our advisors to really. There will be some, there are always some, but it'd be rare for clients to really try and scratch the surface and look beneath at all of the individual holdings and syndicates and so forth, because I guess as an asset class, it's one that people do typically resonate with, and they tend to understand reasonably well. But of course, there's always those that wish to dig a little bit deeper. And just coming back to the whole personnel piece, we have regular engagement with our managers on a monthly basis, where our advisors are fully briefed on any changes that have happened within the portfolios and the reasons behind that. So they're fully armed to have those conversations should they need to. But very rarely, when you're sitting in an environment where you've maybe got 20 or 25 different instruments within a portfolio, it's rare for clients to really drill into a single asset and try and understand what sits underneath that.
Okay. Look, there was one final question which came from one of the audience. It's a technical question. So, how do you deal with PI insurance providers to avoid huge premium increases if debt is included in the portfolios? William, this is probably one for you, and I'm not sure whether PI is part of the portfolio managers.
I probably need to take that on notice in conjunction with my COO. But I'm fairly comfortable that our insurance coverage is sufficient to account for any potential downside in our investment process. But we do try and mitigate that through our investment analysis and governance as much as we can.
Yes. Yeah. All right. Look, thank you very much. So Matthew Swieconek from Findex, William Morgan from Atrium Investment Management. Thank you very much for your time and for the trouble you've taken today to explain the role of property and infrastructure in portfolios. It's been a pleasure for me to take part in this conversation and to have a better understanding of your two processes. So thanks very much. And to those of you who've joined us as the audience today, thank you for your questions and for your attendance. And we'll look forward to having you join us again in IMAP in our November webinar series. Thanks very much.
Thanks, Toby. Thanks, everyone.
Thank you, Toby.